Hello and welcome to another edition of Market Briefing. I'm Martin Bakkerdax, European business editor here at the IB Times UK. Interesting day across the European financial market space. We're seeing all sorts of activity. No specific driver to what we're seeing in equity markets or the euro, but really just a collection of risks that have put investors on the back foot. Broadly, we're seeing stock indices down about 0.75% across the board. Really just a lot of position squaring, and again, no significant push to the downside, other than the fact that you're seeing, of course, continued questions about the bailout for Cyprus, what sort of capital controls are going to be put into place, and whether or not this represents a template for future financial rescues. What we're also seeing in Spain is a remark of the 2012 budget deficit to around 7% from a previous measure of about 6.7%. The government says that's a new measurement based on some new accounting standards. It doesn't necessarily reflect what's going to happen this year, but investors don't like what they see, and they've marked up Spanish 10-year bonds as a result. Italy had a €7 billion 5- and 10-year bond auction this morning that actually went reasonably well when you consider the political backdrop, in which we're well past 1 month and the government really hasn't had a chance, well, hasn't formed at all, I should say, after the indecisive elections at the end of February. It's looking increasingly like Europe's third largest economy is probably going to have to go to the polls yet again. Consumer confidence also fell across the Eurozone today and really wasn't that great in Germany, it has to be said, either. So what we're seeing is those collections of risks putting the single currency on the back foot. It's trading close to, but not quite there yet, at a year low against the US dollar. But there is some technical market concern that if it were to breach that 126 level, it could tumble quite significantly down to the 121 level. Again, a long way from there, but worth paying attention to nonetheless. Now, here in the United Kingdom, big news for the banking sector. The Bank of England's financial stability report came out. It's basically suggested that the biggest lenders in the United Kingdom are going to have to raise another £25 billion in capital buffers in order to protect savers and indeed investors, not only for potential losses of the assets that sit on the bank's books, but it has to be remembered fines and compensation that the industry is probably going to have to pay in the future. You have to remember that last year, fines and compensation payments basically wiped out around 90% of the bank's core earnings, so it's no small beer indeed. That $25 billion number, though, probably a little bit shy of some analysts' anticipations. We've seen references of figures as close to as much as 35 and even higher, all the way up to 40 billion, and some of the capital has already been raised. So as a result, bank share prices have actually popped up a little bit. One other story worth checking out is the FSA fining the Prudential £30 million and censoring its CEO. They basically say that when the insurance group was looking at buying AIA, which was the unit of the failed American insurer AIG, it didn't really give enough forward notification to authorities about the deal and about how it would transform Britain's number 3 insurer. So they fined them $30 million and censured the CEO as a result. Shares are down about 2% as a result of that embarrassing finding from the from the FSA. That's it for us. Do check out the economy page. We'll see you tomorrow.